In Chapter 7, we also get into notes receivable. So these are going to be more long-term receivables than the account receivable, and they're also more formal. Like all debt instruments, it will have a principal, rate, and time. Those three items always have to be on any debt contract stated specifically. Okay, so let's look at problem 8. It's pretty straightforward. So I kind of want to just quickly go over it. It's a nice overview, and then we'll get into the more complicated ones that will require the use of our financial calculators. So in problem 8, if you will, it's on page 398 of your textbook. We have a company buying a piece of farm equipment, and they are selling, not buying, but selling a piece of farm equipment. So we have this $120,000 going into, notes receivable instead of accounts receivable, and we've got our sales revenue. The solution and the problem doesn't ask for the cost of goods sold entry, but of course, if you're selling something, in addition to sales revenue, you would have your cost of goods sold expense and reduce inventory as well. They just didn't ask for it. Okay, then that occurs at the beginning of October. At the end of December, assuming this also is their fiscal year end, 3 months have gone by, so we want to accrue interest, right? 3 months have gone by, so they've earned interest. So we will have interest receivable coming in, and then we also want to recognize interest revenue that's been earned. So let's figure how much is that going to be. The principal of the note is $120,000. We have an 8% interest rate. So for a whole year, that would be $9,600. However, we haven't held it a whole year. It's only been October, November, and December. So that's 3 months out of 12. So we would accrue $2,400. Okay, so let's put that $2,400 in our journal entry. And then let's go post what we've done. We've put $120,000 in notes receivable, and we've also entered in $2,400 for interest receivable. So at the end of 2014, although the problem didn't ask for it, let's focus, not just on journal entries, but what's going to be the outcome? What's going to be reported on the financial statements? So we would have these two balances, $120,000 for the note receivable and $2,400 for interest receivable. And then interest revenue, for 2014 is that 3 months, $2,400. Okay, and then revenue will get closed out, to retained earnings, and then a whole nother year goes by. It's October 1. Now they will receive half of their interest payment. So they're going to get cash for a whole year. They're going to get $9,600. Let's change colors. Let's move to black for the second year. So in the second year, since they've issued the note, they began on October 1, and then a year later, they're going to get 1 year's worth of interest, this $9,600. And so now, what do? Well, they've got this $2,400 in interest receivable. So we are now collecting that. So we want to reduce interest receivable for the 3 months, $2,400. And then the 9 months in 2015, the 9 months that pertain to 2015, is going to be interest revenue. Let's see, $9,600 for 9 months is $7,200. Okay, so let's put our $7,200 there. And let's go post. So we are reducing interest receivable, $2,400, and that zeroed that out, right? And then we would have had $7,200 in our revenue. Okay, now 3 months go by. And we will have a right to accrue another 3 months. We haven't received any cash, so we're going to accrue interest receivable, again, for another 3 months, $2,400. We already did the calculation up here. 3 months of $9,600 is $2,400, and recognize interest revenue for $2,400. Okay, let's go post that. So we post our debit, and we end up with a debit balance at the end of 2015 of $2,400 in interest receivable. Nothing happens to notes receivable, right? We didn't make any entries, so that stays at $120,000. Then interest revenue, we have 9 months that we recorded on October 1, and then the other 3 months, right? The other 3 months that we recorded December 31st. So we add those together, and we'll get $9,600 would be the total balance in interest revenue at that time. Okay, then another 9 months goes by, cash will come in, again, this $9,600. We want to zero out interest receivable. So get rid of the $2,400 in interest receivable. And then we also want to recognize that 9 months in 2016 of interest revenue. 3 months and 9 months. Okay, we post our interest receivable. That zeroes out. The other thing that happens on this date is this is the end of the life of the note. So now we're going to collect this $120,000 as well. So in addition, we have an entry for cash coming in, $120,000. And we're going to get rid of our notes receivable, remove it, of $120,000. Let's post that credit to notes receivable. And we can see now it will zero out. So when we go to our financial statements for 2016, there's nothing on the balance sheet because we've collected those receivables. Now for the income statement, we have this $2,400 interest revenue. If I add up all the interest revenue, I'm going to get $19,200. And that makes sense because if the annual amount is $9,600, take that times 2 years, we get our $19,200. Okay, so that is that particular problem, just working through it. One last point. Let's talk about the balance sheet and connect this with what we've studied before. We have 2 assets. So in 2014, are these assets current assets or long-term? Well, at this point in time, and these are not going to be collected until 2016. That makes that a long-term asset. However, the interest receivable, recall, that got collected in 2015 down here. So cash did come in 2015. So that's going to be a current asset. In 2015, though, the note receivable becomes short-term because it'll be collected in 2016, and so is the account receivable.